We are back with Phil Davis, founder of philstockworld.com. Well, markets can certainly be volatile. When that happens, investors can find themselves in positions they'd like to fix rather than throw away. Now, Phil, you have an options technique you call the salvage play that you came up with during the 2008 financial crisis. Walk us through it. First, what is a salvage play?
A salvage play is a part of a broader strategy. We like to scale in, and everybody should scale into position. So when we take an initial position, we're not taking we've got more money in reserve just in case something goes wrong. With options, it's especially powerful because if something goes right with an option, you can make 5-10 times your money back. But if something goes wrong, people don't really have a good plan for that. And that's what a salvage play is. So in other words, we'll take a small initial position that's going to be, if everything goes perfectly, we can make 10 times what we put into the position. But if it doesn't go perfectly, what do? Well, that's what we salvage. We take the value part of the play. Like let's say we did a bull call spread. That means we have a long call and a short call. But when the long call and short call both lose money, they're both going to lose money when the stock goes down, then sometimes the long call will still have value. And what we do is we salvage that value by pulling it out. We cash in that long call, leave the short call play, but cover it with another brand new long call play that we take the money from the initial spread, from the initial long calls that we had. So we save the value we have in the investment. So, our long position, we save it and move it like to a longer time frame. It's very powerful because you're effectively just sort of using those remaining short calls as an income producer for your new spread.
Okay, so we understand the theory behind it. Now let's put it into practice. You actually have some examples of the process. We're going to start with a company that I'm not familiar with. It's called Lovesac, ticker Love, a furniture company.
Lovesac's a furniture company, makes modular couches, but they do other stuff now. But basically the concept is every single section of the couch is an individual module, and they sell them bit by bit. And they've got this clippy things that hold them all together. So basically, however you want to move your blocks around of your couch, you can. It means you can actually redesign your couch and redesign your room with whatever pieces you have available. You don't have to sit with one position. You can have a corner piece. You can change your corner piece to a long piece. You can put your long pieces together and go like that and have a double wide. Lots of fun. The idea is they got caught up in a manufacturing nightmare, of course, getting stuff from overseas, the materials and so on and so forth. So they've had supply issues and delivery issues and things like that. The stock fell 50% since we started the position in August, only August, but that's because they have short-term options. We're moving to longer-term options. So we're taking, again, the call value of the stock that is still in it, and we're moving it to an April 40th, 1250, 1750 spread. So it's 40 of a $5 spread has $20,000 in potential. And we've invested so far $12,500 into it. So what we've done is we've taken the money that we've invested, we've added a little bit more money, and we've created a brand new trade with a longer time frame at a lower strike. Our target is much lower now.
Okay,
and that's the key also.
My wife would love that company, so I'm going to tell her not to watch the show tonight because she likes to move her furniture around all the house. Drives me nuts.
It's fun, I got to tell you.
I know, she has a good time doing it. Next one you have here is Qualcomm. Explain to me here.
Well, Qualcomm's a great stock, and in this case, actually, it wasn't doing badly, but we applied the same principle because it hasn't moved either. So it's about the same. It was a teeny bit higher in March, and now we're here. But what we're doing is we're moving out now to the 2026 spreads. So we are cashing in our 2025 115 calls, right? And we're rolling those to the 2026 100, 120 spread, 20 of those. So we're putting more money in, and we are expanding our spread to now a $20,000 spread. But we're also going to sell because Qualcomm, to me, is crazy under 100. So we're very comfortable owning it if it gets to that strike. So we're going to sell 10 of the 100 puts. 10 of the $90 puts is what we're selling. And by doing that, we're actually creating a net credit on the roll. So not only are we able to put ourselves in a better, larger position with lower strikes and more time to hit it, but we're also selling calls and creating a credit for ourselves. Actually, it's a $9,600 total credit on a $20,000 position. So if Qualcomm's over 120, we'll make $29,600.
Okay, we've talked about the salvage play with Lovesac Company, with Qualcomm. You got another one on the list here, Sunpower. Walk me through this one.
All right, now, first of all, Sunpower has been a huge disaster the last couple of days because they dropped from $6 to $4. The reason is because they announced they have to restate their financials, but people, that of course, everybody freaks out. They think there's something really wrong with the company. They've done something terrible, so on and so forth. The reality is, though, in this situation, they're telling you they're restating their financials because they miscalculated a consignment block. So in other words, one of their suppliers gave them parts on consignment. They mistakenly categorized it as inventory that they owned, which means therefore they declared it on their balance sheet, and they expensed it differently, and they wrote it off differently. They made several, things that have to be fixed. That's the restatement. It may affect their profits a bit. It may affect their sales a bit. But in reality, does it change the fact that they're growing at a phenomenal rate? Does it change the fact that they're going to expand drastically? Does it change the fact that they have a gigantic tailwind, being a solar power company, installing in the U.S. with all these stimulus bills happening that go to their industry? No. So we love it. It's for us, it's a chance to do more. So having it fallen this far, what we're doing is we're rolling into a much larger trade. We had 50 long calls of 2025. We're moving those to 100 of the 2026 3.7. So it's at 4 now. We're buying the 3s and selling the 7s. Originally, we had the $5 call. So we dropped our calls $2 and moved the 3s to the 7. And I think we're spending about $11,000 to do that, but we've got a $40,000 spread. So we have a $30,000 upside potential on this change. I think we also sold some puts, like 30 of the $7 puts. So, this is just a huge opportunity to jump in. People can look at this trade, on our website. We have all the portfolios laid out. They can look at this trade. For a new trade, it's a fantastic deal right now. People are misunderstanding what's wrong with the company.
All right, very interesting examples there, Phil, of the salvage play. Of course, for the viewer, this is not advice. Do your own homework and research before you make any investment decisions, but definitely some interesting things. We're going to come back with Phil up next. He's going to give us 2 top trades for today. You're watching Money Talk.